Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. Today, we're going to start with a quote by Federal Reserve Chairman Jerome Powell. We are navigating by the stars in a cloudy sky. Today's video is going to focus on the Jackson Hole meeting in Wyoming, where Federal Chief Jerome Powell did roughly about a 15-minute press conference giving us the insights of what the Fed sees and what they're going to do with their monetary policy and how they foresee that monetary policy playing out over the course of the next few years. So let's just dive right into it. So first we need to start with one thing, and that is the mandate. And when I say mandate, what is the objective of the Federal Reserve? They have a dual mandate: maximum employment and price stability. Price stability means that the price of your goods, your food, your energy costs, your housing, your cars, everything that consumers buy goes up at a slow pace as wages rise. When we have high inflation, price stability is off the charts. That things become unaffordable. And that when things become unaffordable, bad things happen to the consumers. Bad things happen to families. So perilously important in order for us to grow as a society. And then on the second thing, a secondary protocol that the Fed must meet is maximum employment. Without price stability, there can't be maximum employment because, again, consumers aren't buying. That means companies don't need employees. And if they don't need employees, maximum employment can't happen. So these are a balancing act that the Fed has to do in order to meet their dual mandate. So given that understanding, let's take a look at what Fed Chief Jerome Powell started at the press conference today in Jackson Hole, Wyoming. I'm going to put this clip up on your screen here, and then we're going to discuss it afterwards.
It is the Fed's job to bring inflation down to our 2% goal, and we will do so.
All right, what they're telling us there is exactly that their objective is to bring down inflation right now. Inflation is roughly about 3%. Their objective over the next couple of years is to bring that inflation number down to 2%. Now, we've had significant progress over the course of the last year and a half, but they still have a way to go. And how do we know that? Let's put that second clip up on your screen here.
Moved down from its peak, a welcome development. It remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective.
It's out of his mouth. Inflation still remains high. It's still an important fight that they're fighting right now. And just because they've made significant progress over the last year and a half, they still have a ways to go. And markets and prices and assets and inflation generally don't come down in a straight line. You know, you'll have either it's going up, it'll come a little bit back down. It's like a stair step, one direction or the other. It's not just a flat line. It's got your ups and downs. So, you know, they can't risk to take their foot off the gas pedal just yet and cut rates and say, hey, we've defeated inflation, when inflation could easily start shooting back up. And guess what? Then they got to start this fight all over again. But there is some silver lining to this in this fight against inflation. Let me put up this next clip for you, and this should give you a little explanation on what their thoughts on how they've been doing so far.
We have come. At upcoming meetings, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks.
Given their success so far, this allows them to not have to, all right, we're going to have to raise rates guaranteed next meeting. We're going to have to raise rates at the following meeting after that. They've seen progress. They also are keenly aware that they are causing some damage in the economy. It's just in these early stages right now. Monetary policy tightening started March 2022. It could take 12 to 24 months before we start feeling the full ramifications of that tight monetary policy, and we've just not felt the full ramifications yet. So it's too early to say we've defeated inflation, and it's too early to say, hey, we're in the clear, the clouds are gone, the storm is no longer on the horizon. We're not there yet. So there is a balancing act right now that the Fed is trying to navigate. again, they're in a tough spot. They're trying to bring down inflation, which if they're trying to bring down inflation, they have to tighten monetary policy. And when they tighten monetary policy, banks, financial institutions can't lend credit to consumers and to businesses. Without credit lending, businesses can't expand. Consumers can't purchase. The society can't grow if we can't get money into the system. So the Fed is tightening on purpose. But if they do too much tightening, then we end up in a recession and a really bad time. Vice versa, if they don't tighten enough, then inflation can't be defeated. And if inflation can't be defeated, there can't be price stability. And then that's probably even worse. And that's exactly what they're kind of leaning towards. Watching this full conference, that's really the takeaway, is that they're going to lean on the side of defeating inflation. But before we get back and get more detail on that, I'm going to pull up this last clip here from the press conference.
But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend. And recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy.
So what did he just tell us there? GDP's high because consumers are spending. Consumers are spending. The data says so. But are consumers spending with their savings? Are consumers spending with their higher incomes? No, we talked about this last week. Consumers are racking up debt. They're using credit cards to go out there and continuing to spend. Because people build up these spending habits, they don't stop these spending habits overnight. They only stop these spending when they can no longer spend anymore. So, and then the housing market is something similar. You know, we've had a decline over the last year, and then we've had this little uptick these last couple months. And that's because so many people have missed out on the housing market in 2020. They've been wanting to buy in 2021 and 2022, but the prices have been unaffordable, so they've been sitting on the sidelines waiting patiently. Well, finally, a lot of people have said, okay, maybe there's the first sign of the housing market decline is starting to disappear, so let's get to it. That's an emotional reaction. That's one it's called fear of missing out. That could be one case, or hey, I'm starting a family, I'm getting married, we're wanting to upgrade, been waiting enough, and we don't care if housing prices are going to keep coming down. It's not a big deal to us. We want our family to grow. And that's another scenario that people are facing. And then some other ones are just like, I don't know what to do with some of my capital. I sold my business, inherited money, and that's another dynamic that could play into the housing market ticking up. Fed Chief Jerome Powell's speech, he also said one thing about the housing market, that we are just starting to see the ramifications of the tight monetary policy, especially the rental market. It's slowly coming down. These things take time, a long time to unwind. So as an investor, patience is going to be on your side. But if you're just looking to raise a family, you don't care about the fluctuations in the housing market, you're looking at a complete different picture, and that's okay. So you got to decide on which side of that lane you're on. Are you on the investor side, or you just want to buy a house for personal happiness and happiness for you and your family? So let me simplify the Jackson Hole meeting for you investors there. And it was back to you right before I showed you the last clip. What is the Fed going to do? The interest rate market is telling us that they're going to hike rates again. I mean, the bond prices have been coming down, and interest rates have been going up. And we see interest rates and bond prices, again, are on the seesaw where bond prices are going down, interest rates are going up, and vice versa. So interest rates have been going up. Interest rates went up preemptively before the Fed even started hiking rates in 2022. They've been going up preemptively before this next rate hike, 2 rate hikes, the unknown amount of rate hikes, because what the Fed told us is they're going to be data dependent. So as inflation data comes in, if it says, hey, we need to hike rates, they're going to hike rates. If inflation keeps coming down, they're probably going to pause and wait. So we, as investors, need to be as flexible as possible and continue to be data dependent, because that's what the Fed's telling us that they're going to do. They're going to be data dependent. So each new inflation data, your consumer price index, your personal consumer expenditures, your producer price index, all inflation data, it's going to be watched closely. It's going to move markets. It's going to use the stock. It's going to move the stock market. It's going to move bond market, because that's what the Fed is going to be watching. That's going to help them make decisions on where they go with monetary policy. And that's probably for the course of the rest of this year of 2023. Now, getting into 2024, that is a whole different ballgame. We got a U.S. political election, and who knows what's going to happen during that time. I tell you who's going to know. We're going to know. Well, we're going to be as best prepared as we possibly can. No one ever could really know. Politics is a whole different game, but we're going to try to be ahead of it as much as we possibly can, be prepared, and make our investment decisions preemptively instead of really reactionary. And data is really only dictate is when we change our strategy. So hopefully that gives you some direction where we're going to see the monetary policy go. It's just going to be data dependent. Next week, guess what we have? We have some inflation data, so tune in with us next Friday. We're going to go over it and decide and give you the insights of where the Fed is going to do with their monetary policy. If you found some value from this video, please do us a favor and like and subscribe. It's always helpful for our page, and get to as many potential investors and investors as we possibly can. Expertise you deserve, experience you can count on.